The current housing boom might once again be over, with mortgage rates jumping to a 23-year high, causing pending home sales to fall to the lowest level that we've seen since 2020, declining 7.1% in August and down nearly 19% year over year. Now you might be saying, Jeb, what's the big deal? Of course pending home sales are declining. Well, pending home sales are a forward-looking indicator. That just shows you there are less people going under contract. And while inventory is low in many markets out there, the real reason that we're seeing this decline is because mortgage rates are getting close to a yearly high of nearly 7.5%. Now, part of the slowdown is due to seasonality. This is a slower time in the market, but my belief is that there's just less able demand out there in the market. You know, we often talk about the willing and the able, and with interest rates sitting near 7.5%, there's just less people out there able to take on that higher monthly payment. So what exactly is causing this rise in mortgage rates? Well, that's what we're going to talk about in today's video. We're going to talk about what is causing that rise, where we're likely to go, and what would cause interest rates to come back down, and how that might affect you as a buyer in today's market. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people, and also subscribe to the channel to stay updated on everything real estate related. This past week, we saw the 10-year Treasury yield climb to over 4.6% after the Fed's Kashkari came out and said that he wasn't sure if interest rates were high enough to actually stop inflation. In fact, he added to the instability in the market, saying that he sees a 40% chance of meaningfully higher interest rates. And with this, we saw the 10-year surge, going back to the highest levels that we've seen since 2007. And while mortgage rates don't directly follow the 10-year Treasury, the two more or less do move hand in hand. So as the 10-year Treasury climbed, we saw mortgage rates climb to the highest level that we've seen in 23 years. And if that wasn't enough, you have Bill Ackman saying that he could see the 10-year Treasury climbing to 5% real soon. And let me be the first to tell you, if the 10-year hits 5%, you're going to have mortgage rates sitting somewhere around 8%, which will put even further stress on the housing market. Now, when I listen to some of these comments that the Fed makes, I think they have to be absolutely crazy. The data out there is showing that inflation is easing, but yet it seems like they have their heads in the sand because they're often paying too much attention to lagging data. And fortunately for us, it doesn't look like all of the Fed members are on the same page. Kashkari seems to be very hawkish, thinking that we need to continue to raise rates to stamp out inflation. But on the other side, we have a more dovish member, a more realistic member of the Fed, Goolsbee, saying the traditional economic view may cause the Fed to overshoot, saying that they shouldn't be placing too much weight on the traditional economic idea that steep job losses are needed in order to quell inflation, and saying that that could lead Fed officials to raising interest rates too high. The Fed actually has a dual mandate. One is to control inflation, and the other is employment. And while inflation has moderated, what we've seen is employment remain really stable, given the presence that we still have a very, very strong economy, with one of the big indicators that they're paying attention to, which is jobless claims, still coming in better than expected. But if we go back to what Goolsbee's saying, hey, employment can still stay low with inflation coming down, and we can back off interest rate hikes. And that's exactly what we need to hear. And ideally, we start to hear more and more of the Fed members talk like this, right? With the idea that they're seeing inflation coming down and that they don't need to continue to hike rates, because that's what's creating this volatility in the market. The unknown if the Fed is going to hike for one more time in 2023, or if they're going to pause. If they come out and say that they're going to pause, that will provide some relief to the market, and in turn, less volatility in interest rates. Now, the other thing that the Fed pays attention to, as I mentioned a moment ago, is inflation. Just rose less than expected in August, increasing just 0.1% for the month, which was lower than the expected 0.2%. And in turn, we saw core PCE fall to 3.9% on a 12-month annualized basis, down from 4.2% last month. And at the same time, we saw housing PCE fall to 7.4% from 7.7% last month. In addition, CPI shelter was up 7.2% year over year, which is down from 7.7% in July. And since asking rents are slightly negative year over year, you're going to continue to see these measures slow sharply over the next couple of months. And because housing and shelter make up such a large percentage of inflation, as those numbers continue to moderate, you're going to see inflation continue to go down. On top of that, you have a couple of different things happening in the economy that will likely lead to slower economic growth due to less discretionary spending out there in the market. And because of all of these different things happening out there in the market, you have U.S. consumer confidence dropping to a 4-month low. And at the same time, student loan repayments just started, which is going to affect nearly 44 million Americans that have to start making payments, which takes money out of the economy, out of discretionary spending, out of things like retail, hospitality, and all of the different places they were spending money, and now it's going to student loans, which in turn is going to lead to lower inflation in some of these areas. In addition to all this other craziness, you have a government shutdown happening, and that's because the government doesn't have enough money to pay their own bills. So someone please tell me in the comments how we hit $33 trillion in debt. We're constantly extending the budget, and in turn, higher interest rates are leading to higher interest payments that the Fed has to pay on their own debt. So as they raise rates, they're putting further stress on their own financial position, which in my eyes tells me that they can't continue down this path for very long. They're going to have to start to pull back. But like we've talked in other videos, the Fed is likely to go too far for too long, which in turn could create additional issues in the economy. But for now, the housing market seems to be frozen up, according to Zillow's chief economist. And now what do they mean by that? They mean that higher rates leads to low buyer demand and just less activity out there happening in the market. And because inventory is not really rising at any substantial pace, you have this blah market out there that I've been talking about for the better part of a year, where you're not really seeing a huge amount of activity due to both muted inventory and muted buyer demand. But here's the deal. If interest rates continue to rise, continue to stay elevated where they are now, that's going to continue to put further stress on demand. And because there's less people out there buying homes, those homes that are on the market are going to sit there, and any new homes coming to the market will add to that inventory. Now, it's really difficult to say because this is a time of the year when inventory would start to pull back due to seasonality. So I do believe there's an opportunity for inventory to grow, but I also believe there's an opportunity for inventory to pull back just due to seasonality alone. But here's the real problem that we have. Higher interest rates and home prices not moving leads to lower housing affordability, which in turn leads to less able buyers out there in the market and leads to lower home sales and a slower housing market overall. So if you're someone at the moment considering waiting to buy a home, completely makes sense. Affordability is out of whack. Housing payments are out of whack. Housing prices are out of whack. So I can completely understand where you would want to sit and wait to see what happens. I don't believe there's a rush to go out there and buy a house. Now, with that said, I'm actually under contract at the moment to buy a property at a higher price than I currently have, at interest rates that I didn't think I'd ever be paying. And you might be asking why? Because it's the right time in my life. It's a property that gives us what we need, more space, it's in the location that we want, and while I am paying more than I want, it's a place that we're going to be in for a very long time, and there's going to be a chance and opportunity for me to refinance in the future. So for me, it's just the right move for me right now. But for you, it's okay if it's not the right move, but you have to wonder why it's not the right move. Is it not the right move because financially it doesn't make sense, or is it not the right move because you think a crash is coming in the market? With the price gap between renting and buying hitting the highest level that we've seen since 2020, it's reasonable to say I'm going to go out there and rent a home until something changes in the market. But at the same time, you have to be realistic about those changes and base it off logic, not emotion, not the idea that, hey, things are just too expensive, I can't afford them, therefore they have to crash. You have to base it off supply and demand. Until you get a lot more supply on the market than you have willing buyers able to buy it, you're not going to see any meaningful move in house prices. And for those expecting foreclosures to happen, Fannie Mae just reported that serious single-family delinquencies decreased once again in August and currently sitting below pre-pandemic lows. Actually, going back to the housing bubble, single-family delinquencies peaked at somewhere around 5.59%. And as of today, when I'm filming this video, we're sitting at 0.53%. Now, at the same time, there is another story happening with multifamily. Now, multifamily is actually starting to see an increase in delinquencies, which is sitting at 0.25% in August, up from 0.12% in August of 2022. And one of the main reasons this is happening is because rent growth is stalling, vacancy rates are increasing, along with lending tightening and interest rates rising. Now, as rents continue to soften, this is probably going to correct itself to some extent, but it's definitely something to pay attention to out there. But here's the thing, multifamily declines don't really translate into declines in single-family homes, but it's something that you have to pay attention to because you could have a trickle effect. You have it in commercial, you have it in multifamily. Could it end up leading to single family? I don't think so, but as you've heard in this video, there's a lot of things happening out there in the economy. And with that, a lot of these things take time to develop, which leads me to believe that nothing's really going to happen until something breaks. With that, the future of mortgage rates for the foreseeable future doesn't look good. And if you're wondering what I'm talking about, do me a favor and check out this video here.